Which the funny thing is, you wish there was room for people. Mine expired this like fall.
You guys get the spreadsheet that I sent, we can check your scores on Saturday.
Right. Oh, that's like a thing, yeah.
I don't know if it's this actually, you know what? I brought some.
If they do like a
You can really connect to one bucket, but if you never gonna go to the garage.
You want to have it?
Yeah.
Yeah. I mean, you can keep it. I was Bro, yeah, everyone wants to do it.
I feel like it's growth development.
All these people, let's do it a week.
Give us some.
So your third quiz is a week from today. So I sent out the email after class today with the review session, the past quizzes. It'll cover pricing, and it'll cover the second packet, which is pricing, what we're going to do today, asset-based valuation, and a little bit of private company valuation, valuation, which we'll do on Wednesday. So packet 2 pretty much is the third quiz. Okay. Your final project, of course, is due on May 9th. I'll send a to-do list for those of you who prefer to check off as you go along by this Thursday. Because if your DCF is done, you just have to mop up. Your pricing has to get done. You got to make a recommendation. None of it should take time, but a lot of little tasks. So I'll send the to-do list so you can get through the tasks. Any questions before we start? So today I'm going to talk about two things that come up. Remember in the first session or the second session, I talked about the 3 basic ways you could put a number on an asset. I said you can do an intrinsic valuation, you can do a pricing, or you can attach this contingent claim or option valuation. And whenever I say that, one of the pushbacks I get is, hey, what about sum of the parts valuation? What about liquidation valuation? So today I want to talk about why I don't think of these as separate ways of putting a number, and why to do liquidation valuation or sum of the parts valuation, you either have to do intrinsic valuation or pricing in the first place. So let's start with sum of the parts valuation. I mean, many of you are valuing complex companies, big companies. They operate in many businesses, many geographies. So when you value a company, you can either value the entire company or you can value it in slices, right? You can value each geography separately, each business separately. That's what sum of the parts valuation allows you to do. So I'm going to ask a kind of a generic question. I mean, when you look at, when you think about valuing the consolidated company versus valuing the pieces, which one do you think would give you the more precise answer if you lived in a world with information that is freely available, and why? Is it better to value consolidated business or break it up into pieces and value each business separately? If you have the information, it's better to value each part separately, right? And here's why. Let's say you're growing in Asia, but you're shrinking in Latin America. Right now, you have to create a consolidated valuation and then think about how your risk premiums will change. Whereas if I could do Asia separately and Latin America separately and the US separately, not only can I give them very different characteristics in terms of cash flows, growth, and risk, I can even value them in different currencies. right? I can do the Asian operations in Chinese renminbi, the US in dollars, and Latin American Brazilian reals. At the end, I'll have to convert them into a common currency. Clearly, if we had full information, we'd value every company as the sum of its parts. So you're saying, why don't we do it more often? And here we run into a practical problem. If I ask you to value Coca-Cola geographically, so Coca-Cola does break their revenues down by geography. They have a rough breakdown of EBITDA by geography, but I'm not sure whether you can trust it because it's based on allocation. But beyond that, it's kind of a mess. Sometimes you'll have assets broken down geographically. Sometimes you have capital broke, but you really don't have a full breakdown of information. The challenge we face with some of the parts valuation is not that we don't know how to do it, but we often don't have the information. Today, I'm going to take United Technologies, a conglomerate, and talk about how I valued some of the parts. And it's a company that provides very rich data at the business level. But even at United Technology, you're going to see me struggle with a couple of items that you're always going to run into when you do some of the parts valuation. So let's say you do some of the parts valuation and you do it right. And you also come up with the value of the company that's out there, right? So you're a multi-business company, you've done some of the parts valuation, you've done this valuation of the company overall. And you're an investor interested in buying a company to break it up. So a very destructive thought, you might say, but there are people out there who buy big companies and break them up. Many activist investors have pushed for that at companies like Sony. Take the company, break it up. So what would need to be true about what you found at the first step for this to make sense to you? Do you want the sum of the parts to be equal to the value of the company, greater than the value of the company, or less than the value of the company? Or at least what's your starting point to make you interested? You'd want the sum of the parts to be greater, right? But then you got to ask follow-up questions. Why is it greater? Is it because of something I've missed? Or is it something that if I break up, because the worst thing that can happen is you think it's greater, you break it up, and you suddenly realize that it wasn't great, that you just missed something along the way. So let's do some of the parts valuation right. And along the way, you're probably going to see why more people don't do it and why when it's done, it's often used, people use shortcuts. So let's go back to slide 103, which is where I think I left you in the regular lecture notes, and talk about asset-based valuation. So in asset-based valuation, the way to think about what you're doing is in intrinsic valuation, you take cash flows, you discount them back at the composite cost of capital, and a relative valuation, you price something. In asset-based valuation, you value a business by looking at its individual parts. Today, I'm going to focus on those individual parts being businesses or geographies. But later on in this class, we're going to talk about how to value user, a subscriber, because you can actually talk about valuing Netflix as the sum of the values of its user base. So this goes beyond just businesses or geographies. Okay? So let's think about when you might be required to do some of the parts valuation. We have no choice but to do it. The first is when you're doing liquidation valuation. A company's decided that it's going to end its life as a corporate entity. It's going to sell off the individual asset. You have no choice but to value the assets individually, because each asset, it's almost like opening up an eBay site for each asset saying, what can I get for it? So I'm going to start with that. The second, and this is where a lot of the money in some of the parts valuation is made by appraisers, is if you think about fair value accounting now requires accountants not to value entire companies, but to value each piece of a company. In fact, they're often asked to value a geography, a brand name, a customer list. So basically, you're required to do some of the parts valuation. And the third is for transactions. We talked about activist investors looking at a company saying, should I take this company and break it up? So some of the parts valuation can show up in liquidation. It can show up in accounting fair value, and it can also show up in acquisitions of companies to break them up. So I'll set the process up by arguing that no matter which of these missions you have, you still have to make a choice. For instance, if I ask you to do a liquidation valuation, you can take each asset and do a discounted cash flow valuation, or you can take each asset and look at what it's priced at. So we have a collection of 10 properties. You can take the rental income on each property, value each property, or you can price it. Same thing with accounting. You can do an intrinsic valuation of each asset, or you can price it. And finally, what passes for sum of the parts valuation out there is often sum of the parts pricing. What I mean by that is an analyst will take a company, break into 8 businesses, and the way he or she will attach a number to each business is look at the EV to EBITDA of other companies in that sector, apply it to that. In which case you haven't done an intrinsic valuation, you've done a pricing. Again, I'm not saying it's better or worse, but that's sum of the parts pricing as opposed to sum of the parts valuation. So I'm going to differentiate between the two. So let's start with when sum of the parts valuation is easiest to do. First, it's easiest to do for companies where the businesses are separable. Yeah. I'll tell you a company where it's very difficult to do sum of the parts valuation. A company like Disney. It's in 5 different businesses, right? Well, there's movies, there's broadcasting, there's streaming as a business now, there's theme parks, there's consumer products. But you see why they're difficult to value separately? Because when you do well in the movie business, it spills over into the theme park business. The movie business can create animated TV shows for streaming. Disney is going to be a really difficult company to do a sum of the parts valuation. In contrast, when I value United Technologies, it is in 6 very different businesses. There's very little overlap between the businesses, much easier to value when you have separable assets. Second, it's nice if each business has standalone earnings and cash flows, as opposed to what? When 2 or 3 businesses create composite cash flows. One of the problems, now I'm going to try to value GE based on the sum of the parts. You know the part of GE that's going to give me the most trouble? GE Capital. Why? Because it's financing GE Aircraft. A lot of the sales they do is financed through GE Capital. And finally, if you're pricing these parts, it's nice to have an active market where there are similar assets being priced. There's a reason why real estate-based businesses are often broken down and priced, because each piece of real estate can be priced as a market out there. So not every company lends itself well to sum of the parts valuation. It's good to know when to walk away, because you have too much interconnection between the companies. Trying to do break it down into its parts is going to give you trouble. So let's start with liquidation valuation. Let's say I'm a company, I want to liquidate. I call you in. Your mission is to tell me how much I will get if I sell these assets today. Think about that mission. If your mission is to tell me how much I'll get from selling those assets today, is your mission a value mission or a pricing mission? It's a pricing mission. It's what I get out there. Because if I gave you an intrinsic value for each asset and you went and tried to sell it and nobody's paying that number, who cares what the value is? So when you look at liquidation valuation, it's almost always pricing. Now that price can be lower or higher than the value, but it's because you got to sell the things and collect the cash to them. So in liquidation valuation, almost everything is pricing. And there's one more caveat. If you tell me that you need to liquidate your business in the next month, you have to do it quickly. Why? Because you have debt payments coming due. I can't just price each asset and leave it at that. I have to ask how much of a discount would I have to accept because I need to sell things quickly. It's like you having to move from one part of the country to another. You got to sell your house in the next 2 weeks because you got to move to another part and buy a house there. You're going to have to accept offers that are probably lower than you'd have accepted otherwise. That's a liquidity discount, a fancy word, but essentially, if you want liquidation quickly, you might have to pay a price in terms of leaving some of the value on the table. Let's talk about accounting fair value. And I've said this before, but accounting fair value is an oxymoron. You can either have accounting or you can have valuation. You can't have both. And I've always believed that the problem with accounting fair value is the mission is so ill-specified that nobody has any idea what they're doing. About 15 years ago, when the accounting fair value rules were being written, the panel that was writing the rules was in New York. And they asked me whether I'd come in and talk to them about what I thought about what they were writing. And I said, sure, send me the broad outline of the rule that's going to drive the mission that you're going to do. And they sent me this rule called FAS 157. So it's an accounting rule. I read through it. And if I had to cut to the chase, as you read through the rule, here's what it requires accountants to do. To attach a number to an asset that they would receive in an arm's length transaction in the market today. That's how the rule is written. Now, if you read that rule and you step back and say, is that a valuation mission or a pricing mission? The answer is pretty obvious, right? That is a pricing mission. But here's the problem. Fair value accounting is you're required to do discounted cash flow valuations to back up the numbers you provide. You see what it do, the amount of frustration you're going to create for accountants around the world? Because you're telling them, give me a number that somebody will pay. And then you say, by the way, do a DCF to back it up. Wrong tool for the wrong mission. I mean, every week I get at least one accountant calling me saying, look, because right now this rule applies not just to companies, but if you run a hedge fund, all your non-traded assets have to get appraised every 3 months. It's a huge make work for appraisers mission, but it's incredibly frustrating. I remember about 7 or 8 years ago, Fidelity was a part owner of Uber because Uber was then a private company. So they bought like 0.5% of Uber. And it's in their portfolio. And the time for the appraisal came about. The accounting team was called in to attach a number to Uber. Now, let's say you're the accounting team. You've been called in to appraise the value of Uber. And you have this mission in mind. It's what people will pay for Uber right now. What number are you going to look at to make a judgment on what you should put on that balance sheet? I mean, it's a private company, but there's still venture capitalists investing in the company, right? This was right after the Saudi investment fund and invested in Uber at a market cap of about 60 billion. You own 1% of Uber, and the Saudis have just paid 60 billion. What should you expect to see there? 1% of 60 billion is 600 million. These poor accountants were working with a discounted cash flow model and coming up with numbers like 20 million, 30 million, 50 million. And they knew they were in trouble. They needed to get to 600 million. They said, we're trying everything, we can't get there. Now, part of that is not being creative and changing market, but part of it is sometimes you can't get there because the market is paying way too much for cloud companies and you own a piece of a cloud company. Guess what? The pricing is going to be very different from value. So maybe we should rename fair value accounting to fair price accounting. And I'm not being facetious, and then require, so if your job is fair price accounting, what's the tools that I should ask you to use to come up with that number? Multiples and comparables, whether it's multiples of users, subscribers, whatever you need to do, because your mission is a pricing mission. So the first two places where we see some of the parts used, liquidation valuation and fair value, it's really some of the parts pricing, not some of the parts valuation because of the way of what you're asked to do. So let's focus on a true sum of the parts valuation. Go ahead.
I'm sorry, why did you take 1% of the 600 million?
Well, whatever they owned, I don't remember what Fidelity owned. It's a small piece of, because it's only their piece of Uber that they have to show on their portfolio.
Okay.
So if it was 1% of the company, you'd have to estimate the value of Uber and take 1% of that. So I don't know what it was, but it was a small slice of Uber, but it had to get repriced. Incidentally, SoftBank ran into this issue last year in reverse, right? When they owned WeWork, and as WeWork started to spin down, they had to keep repricing it. And I'm sure there was a discounted cash flow model that people were writing as they went along, but it's such a waste of time. Why are you even going down that path when your job is a pricing path? Which brings me to sum of the parts valuation. To do a true sum of the parts valuation, you need detail. You need detail not just in revenues, not just in operating income, you need on CapEx and depreciation and working capital and all the ingredients that go into a traditional valuation. You also need cost of capital by business. Luckily, the way we've approached cost of capital with bottom-up betas, we can get cost of capital by business, but if you use a regression beta, you're already stuck, right? Because you're not going to get regression betas for each of the different businesses. So the reason you do sum of the parts valuation is if you want to buy a company, break it up and sell it as businesses or run it as different businesses. You don't even have to sell it. If you truly believe that they'll be worth more as independent businesses rather than this conglomerate holding that you've created, there's an incentive for doing so. So the company I'm going to use is a company called United Technologies. I used to call it the poor person's GE, but it's now probably the rich person's GE because it's actually a healthier company than GE. So at the time that I valued in 2009, it was in 1, 2, 3, 4, 5, 6 businesses, very different. So Carrier's a refrigeration systems business. Pratt & Whitney is a leading defense contractor. Otis is the elevator company. Many of you might have seen Otis elevators in buildings around the country. UTC Fire and Security, obviously, is a security company. Hamilton Sundstrand is a manufacturing company, and Sikorsky makes helicopters. 6 very different businesses. But here's what I told you, that United Technologies is pretty unique in the amount of data. They broke down revenues by business, EBITDA, pre-tax operating income, CapEx, depreciation, and total assets. Most companies, you see revenues, and that's it. Some companies, you see operating income. Very few companies do you see the breakdown go down to the level of detail that you saw United Technologies do. That's why I picked it to do my sum of the parts valuation, because otherwise the information would not be there. I'd be making up stuff. The company also had corporate expenses, and this is often the biggest challenge when you do sum of the parts valuation. You know what those corporate expenses are? You have one big company, all these different businesses. There are some things the company does that are centralized. Maybe the accounting, maybe the inventory. So there are some parts that are in the central headquarters building, and the corporate expenses, which were unallocated to the divisions, were 408 million. We'll have to decide what to do because we can't ignore it. Because if you miss it, you're going to overvalue the company, the sum of the parts valuation. So here's the first step. I'm going to just price the parts. This is the easiest thing to do. And most of the time when analysts talk about sum of the parts valuation, this is all they've done. You think there's something deep that's gone on. Here's what I did. I took the EBITDA of each business, which had broken down. I looked up the EV to EBITDA for the sector. I multiplied the EBITDA by the EV to EBITDA. I came up with the sum of the parts pricing for this business, but you can see why it's so back of the envelope. If you were playing devil's advocate, what are some of the pushbacks you would give if I do this? Because you're going to see analysts do this. Take earnings for each. What are some of the things that you'd be worried about? Yep.
You've ignored the unallocated.
One is the unallocated. So clearly, what am I going to do with the 408 million? But what about the fact that I'm using the average multiple for each sector?
They're not adjusted EBITDA.
I could. So let's say I did adjusted EBITDA, what would you adjust it for?
For a lot of things, one time.
But then I have to use an adjusted multiple, right?
This is an adjusted one.
This is just a sector average, right?
Yeah, you're assuming that these are average businesses.
Exactly. Anytime you use the average, you're assuming that just like, this is like pricing. I mean, we talked about just applying an average P. So already I've given you an opening into one way. If you want to stay with pricing, you can make it a little more sophisticated. So here's what I did. I decided to go into each of the sectors and pick the multiple that worked best in each sector. They were very different sectors. How did I pick the best multiple? I ran a bunch of regressions, see which one I got the highest R squared with. With each of the 6 sectors, I chronicled what that was. And you can see that in 2 of the sectors, I used EV to EBITDA, 2 I used EV to revenues, and 2 I used EV to invested capital. I'm completely agnostic. I'm not saying this is the best multiple. I'm saying this one worked best in each sector. The advantage here is not only can I use different multiples for different businesses, but because I've factored in differences in margin, differences in tax rates, I can now plug in what United Technologies is in each business and come up with a predicted EV to sales for each business. So that's what I'm going to do. I'm going to take these regressions, come up with predicted EV to sales ratios. That's what these numbers are. And in the last column, I have my estimated pricing. I should take out the word value. Estimated pricing, but the difference here, instead of using the average for every sector and EBITDA for every business, I've essentially picked the multiple that works best and come up with my best estimates of enterprise value. I can't average across the multiples because they're different multiples, but I can add up the enterprise values. The number I come up with is 74.23 billion. Yes?
What was the dialogue for choosing the scaling variable?
Well, I picked whichever multiple gave me the highest R squared in each sector. So I ran all 3 in each sector because those are my 3 EV choices. And I picked the one with the highest R squared because my prediction comes with the smallest standard error. So again, it's purely agnostic and data-driven. I'm not saying one works better or the other works. It just, at least in this sector, I can make better predictions on that basis. You can see now if United Technologies at a startup business where they weren't losing money, I can still bring it in, right? I could use enterprise value per subscriber or enterprise value per user if that's what works for a startup. It gives me a lot more room to be able to price pretty much any kind of business. The value I got with my adjusted numbers was 74 billion. Just to provide the contrast, when I applied the average, I got 61.7 billion. I still haven't taken into account the corporate expenses, but without factoring the corporate expenses, at least so far, that would be my some of the parts pricing. Yes.
What's the thought behind not using the equity multiple and just adding that debt?
Okay. The problem with equity multiples is by business, you don't have a really good sense of what the equity is, right? I mean, you don't have a market cap by business. The enterprise value, I can basically value the whole business and then reallocate across the businesses because the company usually carries the debt. The divisions don't carry the debt. So in general, when you do some of the parts stuff, unless you have a financial service business in the mix, because there you have to use an equity multiple, it's usually better to stay with an enterprise value multiple. Now let's do a full-fledged sum of the parts valuation. To do a full-fledged sum of the parts valuation, I need to start with the cost of capital by business. And we've laid the groundwork for this, right? Because of the way we do cost of capital, I just went back and looked up the unlevered betas for each of the businesses. And the debt to equity ratio that I'm applying here is the company's debt to equity ratio. Again, because the company doesn't break debt down by business. Now, if you truly feel that you want to allocate the debt and have different debt to equity ratios by business, do so, but do so only if you believe the businesses are widely divergent in terms of how much debt they can carry. Here with the same debt to equity ratio on the unlevered beta, I get the levered beta. So if you look at the last column, you can see the cost of capital for these businesses range from less than 7% to for fire and security to close to 10% for Otis, the elevator company. Very different cost of capital because they're very different risk profiles. Now to do the rest of my valuation, I went through the fundamentals. Basically, I computed the return on capital and reinvestment rate by business. So think of these as 6 separate companies. And because I have the information, I'm treating them as 6 separate companies within United Technologies. The returns on capital again, widely divergent. UTC Fire and Security was the least risky business, but it also is the lowest return business. Otis was the most risky business, but it's also the highest return business. So the returns on capital vary widely across businesses. And clearly, the company is reinvesting more in some businesses and less in others. And I've got to capture that in my discounted cash flow valuation. So I've got a cost of capital by business, returns on capital and reinvestment rates by business. As if you try this on your company, this is probably the place where you're going to hit a rock wall because you might have trouble estimating invested capital by business, reinvestment by business. In the case of United Technologies, again, because of the kinds of information they provided, I was able to do this. Now I can kind of choose different discounted cash flow models for each one. Let's take the extreme. UTC Fire and Security, I treat as a mature business already. Why? Because it's growing at a low rate. They're not reinvesting much money. It's a low cost of capital business. So they're already in stable growth. So think of this as the growth period. So remember the 10-year growth period I use for every company? Here I'm slicing and dicing. So I have some high growth. None of these businesses are really high growth. But again, you can ask a what if. If UTC had been in a technology business with really high growth, I could have put in a 10-year growth period for it and valued it separately. And in this, as with all valuations, you got to tie up your loose ends. And in the last phase, I make my judgment of whether the competitive advantages that these businesses have will last forever. I think UTC Fire and Security, they're going to end up at the cost of capital. I don't think they can continue. But if you look at the rate returns on capital across businesses, some of these businesses, especially Otis, can, because of its brand name, its competitive advantages, can continue to earn above its cost of capital. So the bottom line is I'm building 6 different discounted cash flow models. And part is saying, that's a lot of work. You're absolutely right. This is why when analysts do some of the parts, they do pricing. It's much quicker, you get a number. But if you truly want to do an intrinsic valuation of each part, there is no choice but to value each business separately. So there's my value. So basically, you take the present value of cash flows, the present value of the terminal value, add them all up. The value that I get, the intrinsic values of all of the pieces put together, is 80.25 billion. I'm almost done. What's one loose end? Corporate expenses. Think of the corporate expenses as cash flows, right? They're negative cash flows, but there's nothing in a DCF model that prevents you from taking the present value of negative cash flows. So here's what I did. I take the 408 million. It's a pretty mature company. I assumed that that 408 million expense would grow at 3% a year in perpetuity. You will get a tax savings from those expenses. The present value of the corporate expense slice going out in perpetuity is minus 4.6 billion. You subtract that from the sum of the parts, the value that you get for the equity is 75.7 billion. And if I, just as a comparison, when you think about the pricing, I got 74 billion. When I did a traditional DCF, I got 71 billion. They're all within shouting distance of each other. Yes. I just used the cost of capital for the entire company because I had the pieces. We go back. No, I had the pieces for each of the. Where's the cost of capital? I had the pieces for each of the companies. I had one for the whole company, which would be the weighted average beta for the whole company. So that's what I ended up using. But don't leave it hanging out there. In fact, I almost never see corporate expenses even brought into the picture when I see pricing. Some analysts will allocate it across the businesses based on revenues or something else. If you want to do that, that's at least a halfway measure. At least you're getting it into the number somewhere. But it has to enter in somewhere. Because if you ignore it, you're going to overvalue the company. Sometimes I wonder whether companies are actually acquired for the wrong reasons. People forget this big corporate expense. They say, this looks like a great deal. I'm going to break it up. And guess what they find? Those corporate expenses now track out to the individual companies, and they wake up the next day to see much lower EBITDA at the company, at each individual company level, because that expense had to go somewhere. Any questions? In 2018, GE was in a lot of trouble, so I decided to do GE's sum of the parts. This used to be 26 different businesses. If I'd done this in 2003, it was 26 different businesses. So by 2018, it consolidated itself. You're saying, why the different colors? The greens are the businesses where they earn above their cost of capital. The orange are the businesses where they earn roughly their cost of capital. The red is the businesses where they earn less than the cost of capital. They're in 8 businesses, 3 are good, 3 are bad, 2 are bad, and 3 are kind of neutral. Now, what's your first reaction? Let's get rid of the bad businesses. It's not going to bring your money back. Remember, your mistake was made 15, 20, 25 years ago. And later on, when we talk about value enhancement, we'll talk about why it's not so easy to fix multi-business companies with bad businesses, because your first reaction is, if I shut the bad business down, I should get the capital back. That's not going to happen because people are going to pay you based on the value of that business today. So sometimes you're stuck in a bad business. There's no escape hatch. I mean, your best case might be to continue to run that bad business and don't do any more damage. Don't grow the bad business. That's still within your control. But getting out is not going to be easy. So there's my evaluation of the parts. As I said, the big challenge for me was GE Capital. It's like a drain on value, kind of pushing the whole company down. And it's a bit, you say, at one part of me said, why don't we just shut the business down? Because if you make it zero, the company would be worth a lot more. The problem I said, it's entangled in all of the other businesses. There's no way you can shut GE Capital down without hurting GE Aircraft, but the financing is done by GE Capital. I mean, when Jack Welch was anointed as the greatest CEO ever, he was anointed on the basis of GE Capital, growing the business. And in a sense, he created a legacy that the CEOs who followed him have been kind of, it's become an anchor around their necks. It's essentially dragged the company down. I mean, the lesson I would take from this is don't enter the financial service business unless you absolutely, absolutely have to, because it's an easy business to get entrapped in, very difficult to extract yourself from once you're in it big time. At one point in time, GE Capital was one of the largest financial service companies in the world. It rivaled the biggest banks. And so its imprint is all over the company. Any questions on some of the parts valuation?
So in case you're valuing an investment or basically a bank like JP Morgan or Goldman Sachs, and you have to do some of the parts valuation.
First, ask, do you want to sum of the parts pricing or valuation? Because that's important, right? What are the questions you would ask a company to see whether they want pricing or valuation? First, why are you doing this? If they want to sell off pieces of the business, they want a pricing. They don't want a valuation. If they want to assess how better to run the company combined, then you want to do a valuation. So first, be clear on what your mission is. And in general, my suggestion is anytime you work in this area, that's the question you need to start off with, is why do you want this number? Because the way you approach this process will be very different. If somebody says, I want to sell break up GE and sell off these two businesses, they're asking you for a pricing. Give them the best pricing you can, bring in all the data, look at the differences. But if they truly want to do a valuation, then obviously you got to start to dig deeper.
Right. But the capital in these financial services is essentially shared, although it is put up in their financial.
But remember, the capital in financial services is just equity capital. This is the problem. You have financial services mixed in with everything else. With every other firm, debt plus equity minus cash. It's invested capital. When you come to financial services, just equity, because debt to a financial service company is not really a source of capital. So financial services don't mix well with almost every other business. The only place we use equity multiples. So one of the things to do is value everything but the financial services. Then take the financial services and value it on an equity basis. You might conclude it's worth nothing to you, but it's a pure equity deal. Because you bring in something like EV to invested capital to a financial service company, it'll blow up on you. It's just not meant for that. So let's talk about private company valuation. Now, to me, when you look at the process of valuing a private company, and this is why I've never written a book on valuing private companies or really done an extended class, the process is exactly the same. What's the value of a public company? The present value, the cash flows you can generate by investing in this company. So you project out the expected cash flows, you discount back at a risk-adjusted rate, and you come up with the present value. That doesn't change if you're doing a private company. But there are aspects of a private company that make the process a little trickier. Let's start with the first one. The first one is there is no market value out there for a private company. Remember the public company, you have this anchor, you can see what's Twitter priced at, what's Facebook priced at. At first sight, you think, who cares? You don't realize how much of a crutch having a market price out there is when you do valuation. And we'll talk about the places it's going to show up implicitly and explicitly. The second is, especially if we're talking about small private companies, the financial statements can be a little tricky. They're not as complete, there are things missing. It's not that they're holding back information, it's that they're not covered by the kinds of GAAP rules that you might have a publicly traded company covered by. So let's start with the no market value and why it matters. First, in your valuation, there are places where market values are inputs, right? What inputs, when you do your discount rate, the cost of capital, the weights is supposed to be market value weights, which for a public company is out there, right? The debt, you might have to estimate the market value, but market value of equity is different. So when you value a publicly traded, a private business, you're not going to get market values. Second, when you have options and other employee compensation at a public company, you have to value those options. To value the options, you need a market price. When private companies give options, and many of them do, the input on what the price is itself becomes a little tricky. There's a way around it, we'll talk about it. But those are the places in valuation where you miss having market prices. Second, I don't know about you, but the minute I finish valuing a publicly traded company, often while I'm valuing a publicly traded company, through the side of my eye, I'm checking out the price. We'll never admit to it, but the reality is, it's nice to have that anchor, right? I mean, if you turn in DCFs of $4,300 per share, the stock was trading at 38. And my response was, there's a unit problem here, because no stock ever gets traded at 1,000 times price. And so it's nice to have that check of, hey, did I screw up somewhere by entering thousands versus millions? And finally, there are risk measures in valuation where you look at market prices to measure risk. What am I talking about? You use a regression beta to value a company. You need market prices. You're not going to get a regression beta from a private company. So market prices are all over the place. We have to figure out what to do when we don't have market prices. Second, let's talk about financials. If you have a large private company, the financials look very much like a public company. Many large private companies are structured as subchapter S corporations, so that the accounting looks very similar. But if you have a small private business, not only do you have a shorter history, but the accounting is all over the place. I remember somebody in this class about a decade ago decided to value a mother's flower business. A mother ran this small florist store. So she said, I'd like to value my mother's business. And I said, sure, go ahead. About halfway through the semester, she came and said, I have to change companies. I said, what happened? You have a fight with your mom? She said, no, I went and asked my mom for financials, and she took me into this room where every wall was covered with Post-it notes. And she said, this wall is my revenue wall. That wall is my expense wall. So basically the way she accounted is, but she's busy. She's putting together floral arrangements. So every time she did an expense, she wrote on a post, at least she used different colored Post-it notes and put them on different walls. And at the end of the year, I guess she pulled down all the Post-it notes and put together her accounting statements. I don't know about whether Post-it note accounting is allowed under GAAP, but I think it might be a little tricky. So with really small businesses, that's something to watch out for. The third is, in private businesses, there's often this intermingling of the personal and the business expense, especially small private business. You know what I'm talking about? There's a company car, but every afternoon at 3:30, it seems to magically be gone for an hour, around the time kids get out of school. There's an office, but sometimes there are toys in the office or other things that are happening. There may be a cooking one going on the side. Anybody who's had a home office knows that the line between the office and the home kitchen is a very gray one. There's a lot of intermingling. And finally, and this is, I think, a big issue. If you own a business, often you forget to pay yourself a salary. You know why? Because you get to keep whatever's left over. So when you show me your financials, even if they're really good and complete, there's a question I need to ask you. The first is, how many hours a day do you spend at this job? And if you run a private business, guess what the answer is? Almost all of my time, 16 hours. What do? I'm the inventory keeper, I'm the janitor, I'm the accountant, I'm the salesperson. Then I'm going to ask, do you pay yourself a salary? And the answer is often no. You see why this is going to lead to misleading valuations of private businesses? If I take the bottom line from that income statement and value the business, and I pay that price for the business, the day after I buy the company, what's going to happen? I'm going to walk in and say, where's the janitor? Oh, she was here yesterday. She's gone now. Where's the accountant? I mean, basically, this owner was keeping the business together and now need to hire somebody to do what she did or he did. And that's going to cost me money. Often in private business, you have to put an imputed salary for whatever tasks the owner was doing, because if you don't do that, you're going to overvalue the company. So let's talk about how to value a private business. So let's say I come to you and say, I want you to value my private business. Before you put a pencil down to paper or start your valuation, you need to ask me why. Why do you need to value? Because the answer I give you could give you very different pathways to valuing the company. The first is, I could just be curious. I just want to know how much. I mean, I've built this business for 20 years. I just want to know how much it's worth. I call these show valuations. Basically, you want to get a sense of what your business is worth. The second is, it can be for legal purposes. Maybe a tax bill is coming due. Maybe you're getting divorced. How I approach the valuation is going to be very different depending on that effect. It could be for a transaction. You're planning to sell the business. And if you say that's what it is, I'm going to ask you more questions. To whom? Now, your reaction is you have a lot of questions. But who you plan to sell the business to can affect how I value the company. Notice we never ask these questions to public companies. With private companies, you need to look at the motive for the valuation to actually start the valuation goal. Because we're actually going to come up with very different values for the same private business for sale to a public company, for an IPO valuation, or sale to another private individual. Now, all these questions we have about private businesses will also play out in public companies when they're trying to sell a division. Because you don't have market prices, you don't have the accounting is diffuse. So it's not just public companies. We run into this. You're going to run into this with companies trying to get rid of divisions they no longer want. So let's start this process by structuring 4 separate kinds of transactions you can have with private companies. The first is a private to private transaction. You know what I mean by that? You own a business. I'm interested in buying a business. I'm an individual, you're an individual. Private. With many small businesses, this is the bulk of all transactions, right? So if you run a small store and you try to sell it, it's usually another individual who buys it. So that's what we're going to start with. To me, these are the most difficult private company valuations, the private to private. Second, we're going to talk about private to public, which means you have a business to sell, but it's now big enough and attractive enough that a public company is interested in buying it from you. It could be a private to IPO. You're actually big enough that you can go public. And you're going to see with 2 and 3 that you very quickly can use the things you did with public companies and get away with them. And we'll talk about why. And finally, you have this transitional phase. You have a private business. It's right now very small. You're approaching a venture capitalist to raise capital because you're not big enough to go public, but your eventual plan is you want to go public. We're going to have 4 separate kinds of transactions and 4 different pathways to get there. So let's start with private to private transactions. And here are the problems you're going to run into that are going to have to be brought into the estimation. First, neither the buyer nor the seller are likely to be diversified. Why? You can't afford to. I'll tell you a classic example. Until a few years ago, if you were a doctor and you built up a medical practice and you got to be 65 or 70 or 75 years old, you sold the practice to another doctor, usually younger, who wants to come and buy the practice. Could you be diversified? How could you? All your money's been going into this practice over the last 30, 35 or 40 years. And the person buying the practice is definitely not going to get diversified. They probably have student loans they're carrying from medical school. So they're going to be essentially almost undiversified. You're saying, who cares? You're going to see it play out in how we estimate discount rates for these companies. Second, once you buy a private business, you have this problem. If you have buyer's remorse, you're in trouble. Let me explain. Let's say right now you decide that Twitter is a good play. So you get out of class today at 3 o'clock, the market's still open. You listen to Jim Cramer as he on at 3 comes on and says, buy Twitter, and you buy 1,000 shares of Twitter. And 5 minutes later, or even 2 minutes later, you have regrets. You say, what the heck did I do? I listened to Kramer and I bought something. He puts out like 4,000 stocks every day. And you sell it 2 minutes later. The cost of buyer's remorse is relatively small, right? First, the transactions cost, what is it, $5 now? If you're doing Robinhood, it could be free. There is a bid-ask spread, but with Twitter, with the kind of liquidity you have, maybe 10 cents. The cost of buyer's remorse for a public company is relatively small. I say relatively because if you bought a NASDAQ stock that's not as heavily traded, the spread's going to be much wider. There is an illiquidity discount with public companies, it's small. But if you go buy a private business, why? Because you like the business, you think it's a good business, and you change your mind, much more difficult to sell it because you got to sell it as a business. So you know what happens in private company transactions? Buyers, when they buy a business, build in, it sounds absurd, but you got to build in that discount you will have to sell it at the time you pay for it. It is, to me, one of the most challenging aspects of valuation is estimating what that discount should be. I'll show you how appraisers do it and the kinds of mistakes it leads to. but you got to estimate that discount. And finally, there's an issue called key person value. Again, not just restricted to private business. I'm going to give you some examples of big public companies. We aren't worried about this. But many private business, we talked about a medical practice, right? A doctor sells the practice and you're buying it as a young doctor. What do you have to worry about? Many of the patients coming into the practice didn't just come in because it says medical practice. They came in to see that particular doctor. Now, if that doctor sells the practice to you, you might wake up the next day and discover that half your patients have fled because they were attached to a doctor. You ran a plumbing business. Plumbing business in suburbs are built on relationships with people that you've helped over 30, 40 years. So when you buy a business, a private business that's built around, some service that's attached to a person, you're going to have to attach a discount when that person leaves, how much of the value will be gone. Now, do you see why it's not just private businesses? What's Tesla worth? $1 trillion. What happens if Elon Musk checks into rehab tomorrow? That's not an outlandish news story. Would you be surprised if that happened? I wouldn't. But think of what will happen to Tesla's market cap. There are public companies. I don't think it's healthy to build around, that's why personality-driven companies scare me as an investor. Because if you invest around think of Martha Stewart, right? The day she went off to jail, I don't know how much a market cap of Martha Stewart living, it's already publicly traded, got lost. But with private companies, this is front and center, that key person discount. So let's set up a very simple example of a private company valuation so you can see it come into play. We're going to value a restaurant. It's an upscale restaurant. And here's and let me set up the game. You're a potential buyer. You used to be an investment banker, but you got tired of the hours and the abuse. You quit your job. You've saved up enough bonuses over the years. You're going to buy a restaurant because you've always wanted to run a restaurant. You have access to the most recent financials, and I've been running the restaurant. And let's say, the person running the restaurant is this well-regarded French chef. It's going to come into play. The well-regarded French chef, there's a name, everybody recognizes the name. Okay? And you see the numbers, basically, that in the last 3 years, the restaurant has been growing. And the most recent year, it reported $400 million in pre-tax operating profit on 1.2 million revenues. The company has no conventional debt outstanding, but it does have a lease on the restaurant space. And that lease commitment is 100. And this was in the years before GAAP actually treated leases as debt. So think of this as a private business with a lease commitment. So ready? Let's try to value this business. Let's start with the easy part first. Let's start with the financials. So we look at the financials. The business has been growing. And it's operating at full capacity. What does that mean? Every night you come in and every table is taken. That's going to become significant, right? You can't just put in a 10% growth rate in here unless you plan to raise prices on all your food items, which you might plan to. You can build that in. Okay? The operating lease expense is treated as like an operating expense then, so I've subtracted it out. But the bottom line is I have all the expenses, but one of the things that I want to draw your attention to is the chef does not draw a salary. Why? Because it's his restaurant. He's going to keep whatever's left over. So why waste your time putting in a salary? But you're planning to buy this restaurant. Remember, the day after you buy the restaurant, you've got to cook the French food. And maybe you're not that good a chef. So maybe you might want to hire somebody to do it. And that guy or person that you hire is probably going to require a salary. So there are a whole bunch of issues you got to think through. So here's what I'm going to do. I'm going to go through this valuation in steps. And some of the steps, you're going to see me do exactly what I did with public companies. But in some of the steps, you're going to see me deviate. So first step is I need to estimate a discount rate. And remember what I said, neither the buyer nor the seller here is going to be diversified. And the reason that matters is the way we've estimated discount rates so far with every public company is by using a beta. We never talk about this, but essentially whenever you use a beta, you're assuming that the rest of the risk can be diversified, or it's implicit. So if you use just risk-free rate plus beta times risk premium like you do for a public company for this transaction, you're going to underestimate the discount rate. You're not factoring in the reality that neither the buyer nor the seller here is diversified. So here's what we're going to do. We're going to talk about how to estimate discount rates with these two issues we run into. One is that the buyer and the seller are not diversified. The other is we have no market values for debt and equity. So how the heck do we come up with weights for a private business? Now, part of you is saying, let's just use book values. It's a terrible solution. It's going to lead you to some really dark places if you're not careful. So let's start with the diversification part. If you think about the arguments we make for diversification, it's that public companies, not everybody's diversified, but the marginal investors are diversified. As long as those marginal investors are diversified, we can focus on the beta. So if this were a public business, the way I'd get a beta, even if it's not publicly traded, is I'd go get the betas for other restaurants. And initially that's what I did. And I came up with the beta. But then I took a look at the list of companies that had come through in my peer group. There were companies like Applebee's, and thank God it's Friday, and McDonald's. And I described this as a French restaurant, upscale. If I showed this to the French chef who ran the restaurant, he'd probably have a heart attack right there. Not to mention the fact that it doesn't make sense to take the betas for fast food restaurants and attach it to an upscale restaurant. Why? Remember we talked about discretionary, non-discretionary? So here's what I used instead to get the beta for the restaurant. I looked up the beta for high-end luxury retailers, and the beta that I got, the unlevered beta, is 1.18. You're saying, am I allowed to do it? You can be creative in valuation as long as you back it up. There are times when you might decide not to use a sector beta for your company because it's so different from the rest of the sector. At which point you step back and say, what are the businesses I should use instead? So this is what I'm going to use as my unlevered beta for the restaurant, not the beta for restaurants, but the unlevered beta for luxury retailers. Now let me structure my argument for why I need to think about the rest of the risk when I look at a private business. So let's create a hypothetical example. Let's suppose you have a company with 100 units of risk. 20 units are market risk and 80 units are company specific. So if this were a company with diversified investors, those 80 units would disappear. You focus only on the 20 units that are left. That's what we do when we use betas. But if you're not diversified, you look at this company, guess how many units of risk you're going to see? You're going to see 100 units of risk. Think of this as an algebra problem. If I give you the beta for the 20 units, and you're exposed to 100 units, you're exposed to 5 times as much risk as a diversified investor. Hence was born this notion that I created. I won't even claim that it's derived is probably too strong a word, concocted, but 30 years ago, that I called a total beta. A market beta is only market risk. The total beta captures all of the risk. So if I could somehow tell you what percentage of the risk in a business is market risk, I should be able to then convert betas into total betas. So with this business, here's what I did. I took those high-end special retailers that I had, the 1.18 beta, the average R squared across the regression. They're all publicly traded. So I can go and look up the Bloomberg beta, look at the R squareds. The average R squared across those companies was 25%. So across these companies, we looked at the regressions. It looks like a quarter of the variance in these companies comes from the market. The remaining 3/4 comes from the firm. I have to take that statistic and somehow use it to take a market beta and make it into a total beta. My market beta is 1.18. Beta is a standard deviation measure. You know what I mean by that? If you look at the statistical definition of beta, it's sigma. So it's basically the standard deviation of the stock times the correlation with the market divided by the standard deviation of the market. So when you look at R squared, you're looking at the variance. So if you're looking at just the standard deviation, you have to take the square root of the R squared, which of course is the correlation coefficient. So my R squared is 25%. My correlation coefficient is going to be 0.5. You divide 1.18 by 0.5, you come up with a total beta of 2.36. Intuitively, here's what you're doing. If I were a diversified investor, I see only the market beta, 1.18. Because I'm not diversified, I'm bringing in the rest of the risk in the company saying, look, I can't diversify away anything, so I'm going to have to be paid for the total risk. The total beta captures your exposure to total risk rather than just the risk you cannot diversify. That's going to have consequences. With that higher beta, if I lever it up and bring it in, I'm going to end up with a much higher cost of equity for the same private business. But once you have the unlevered beta, to lever up, I need a debt to equity ratio, and that debt to equity ratio has to be a market debt to equity ratio. And here I have to face up, what do I do? Because I don't have market debt and market equity. I'll give you two solutions. I'll give you the easy one first, and I'll give you what I think some of you might find more satisfying next. I don't have a debt to equity for this company, but I do have a debt to equity for a typical restaurant. Now I'm going to go back to a restaurant business because in leverage, but what do restaurants need to borrow? The typical debt to equity ratio for a restaurant is 14.33%. I'm going to assume that if you're in this business, you're kind of stuck with that debt to equity because it comes from being in the business. I'm using the industry average for public companies as my debt to equity. You see why it's not that satisfying a solution? You're saying, what if private companies borrow less or borrow more? There is a second solution, and it does require that you get a little creative with Excel. I've talked about the iteration box in Excel before, which is if you go check it out. What if you could use your estimated value of equity in your cost of capital calculation? Let me step back. You use this to come up with the cost of capital. The cost of capital gives you a value of the firm. The value of the firm gives a value of equity. What if you could take that value of equity and use it as your weight on equity? The problem, though, is to get that value, I need a cost of capital. And to get the cost of capital, I need the value. I have a classic circularity problem. But if you check the iteration box, you can actually set up the debt to equity ratio for a private business based on your estimates of debt and equity. But make sure you check the iteration box, because if you don't, all heck is going to break loose in your Excel spreadsheet. You're going to get that circular reasoning warning. But essentially, you're using your estimated value. So basically, you have two choices. One is to go with the industry average. It's easy because you go look up for public companies. But then you're assuming your company is just like the industry. Or you use your estimated values of debt and equity as your weights in your cost of capital. But get rid of the circularity by making sure the iteration box is checked. Yes?
Why are you using a publicly traded restaurant data in this case when you were using the retail?
Because for the risk, I'm worried about the risk being like a luxury retailer. But for the portion which is debt and equity, I'm thinking about how does a typical restaurant, how much debt does it have? So the typical restaurant needs to lease that restaurant space and I want to be closer to the business for the leverage. So I'm actually using two sets of peer groups, one for the unlevered beta and one for the debt equity, at least in this case. But for you might have to pick and choose, right? Based on your private company, you might end up with the same peer group for both, different peer groups for each. But that was my reasoning to go back to the restaurant business for the debt to equity while using the luxury retailers for my unlevered beta. So I end up with the cost of equity. There was T-bond rate that was 4.25% based on the levered beta of 14.5%. Based on the risk-free rate and the equity risk-free rate. Why is it so high? Because the investor who's buying the business is not diversified. Now, to get the cost of debt, again, if I wanted to go look up a bond rating, I'm not going to find it. Moody's doesn't rate small private businesses. They usually borrow from the bank. But here again, I cheated. How do I get the cost of debt for a public company? I used an interest coverage ratio. If you're a lender to a private business, you worry just as much about buffers as I did. So I used that table. I used a small risky business table. Maybe I should create a third one for really small, really risky businesses. But basically, it's using the interest coverage ratio. I can get a synthetic rating. Synthetic rating gave me a default spread of 3.25%. I used the tax rate for an individual because the person owning the business was going to be taxed as an individual. There's no corporate tax rate here, giving me an after-tax cost of debt of 4.5%. You take the weights based on the industry average. Again, stay consistent. If you decide to go with the industry average, lever the betas, that'll now become the same debt ratio in your cost of capital. The cost of capital I end up with for this restaurant is 13.25%. I'm going to later on show you what the cost of capital would have been for this restaurant if it had been a publicly traded restaurant. And obviously, it's going to be much lower. And we'll talk about what that creates in terms of long-term consequences for small private businesses. because there is a game that's going to play out over time, where your best potential buyer as a private business might not be another individual. It's often going to be a public company or somebody who can ignore that firm-specific risk because it's pushing up the cost of capital. Any questions on mechanics for cost of capital for private companies? So do the same process to get unlevered betas, but adjust for the fact that the buyer is not diversified. In fact, on my website, I have total betas by sector. So if you go to the data section of my website, that's not meant for public companies. It's meant specifically for small private businesses. And you notice the average beta is like 3.5. And you say, how can that be? The average total beta can be 3.5. It's not structured to be around 1 because I'm looking at the rest of the business. So step 1, I've got my discount rate. Step 2, I'm going to go clean up the financials. And these financials were relatively clean. I mean, there are some small private businesses where there's a heck of a lot of cleaning up to do. But here the cleaning up is relatively minor. One was a pretty standard cleaning up that I'd have done even for a public company then, which is to take leases and treat them as debt. But the bigger change that I put in was I put in $150,000 in extra expenses because I now need to hire a chef. If I buy this business, I'm going to be either spending a lot of time in the kitchen learning French cooking or hiring somebody else to do it. That $150,000 lowers the income. So basically what you see as my adjusted income for the company reflects the restating of the financials. With private companies, always ask the question, do you pay yourself a salary? Do you pay yourself a sufficient salary? And what do you do? Because you need to replace this owner when he or she decides to leave the business. So step 2 is relatively similar for both private and public. It's the cleaning up to make sure you brought that salary. Step 3, I'd ask the question, if I buy this restaurant, will my restaurant be as filled the day after I buy it as the day before? And the answer is, I told you the owner of the restaurant is a well-known, big name French chef. And remember, people often go to restaurants, especially high-priced restaurants, because of who cooks at the restaurant. Right? A big name can be a big draw. So this is a tough one. The question I'm asking is, tomorrow, if I own the restaurant and everybody knows the chef has left, what percentage of the customers will keep coming and what percentage will be gone? I don't know an easy way to answer the question. Maybe you need to stand outside the restaurant and ask people as they go, and will you come back tomorrow? You know, this person's still not cooking. But in this case, let's assume that 20% of your customers are attracted to the restaurant because this person is cooking. And if he or she leaves, they leave as well. I've reduced my operating income by that 20%, which means when I value this restaurant, I'm going to give it a much lower operating income because I'm saying, you see how this hurts both sides? So the seller of the restaurant is now going to get a lower value. The buyer of the restaurant is, gives out 20% of the revenue. Isn't it in both sides' interest to keep this key person discount out? Is there something that you can do to reduce or eliminate the discount? You often see these with medical practices or dental practices changing hands. I'm sorry, what?
Unless you like hire the same chef.
That guy is not coming back. He wants to retire. I mean, clearly, if he wanted to be an employee, he wouldn't have sold the business, right?
Non-compete agreement.
That protects you from him opening a restaurant next door. They definitely do that because that means you're not getting wiped out 100% because the guy leases the next door space. But you got to go beyond that.
Succession planning of some kind?
In fact, often what you will see is when doctors sell practices, the old doctor will stay on for a couple of years. They basically kind of step back from the action. They'll actually just come around, introduce the patient to it. And they're doing it not out of the goodness of their hearts. It's a way of kind of buffering the impact so you can transition plan better. Okay? It's a way of reducing the key person discount. So definitely non-compete has to be in there. But in addition, you need to figure out a way to cushion the impact of that transition so people now say, okay, this new guy is pretty good too. He cooks good food as well. But it takes a while. Having the old chef around for a year or two might arrange it. So often you will see that overlap between the old plumber leaving and the new plumber taking over a business, the old doctor leaving, because that's one way to kind of reduce the impact of a key person discount. And just because you're valuing a private company doesn't mean you forget all the stuff we've learned in valuation. Like if you want to grow, you need to reinvest. What is that reinvestment going to depend on? Your growth rate and your return on capital. I'm going to use very familiar equations, basically. The return on capital here for the restaurant is about 20%. If I want to grow 2% a year, that means I have to reinvest 10% in what? Hey, even if your restaurant capacity is not growing, you better spruce up the restaurant. You got to spend on the interior. You got to the kitchen stuff might need to get replaced. This is the 10% you're putting in to keep the restaurant going and looking good. So I have everything I need. Let's value the restaurant. I start with the 296,000, the key person adjusted operating income. I knock off 40% after, so it's after taxes. The 13.25% is the cost of capital I got with the total beta. And the 10% is my reinvestment. This should be pretty familiar. So basically I have 296,000, grow it out a year, net of taxes after reinvestment. So that's my free cash flow to the firm next year, divided by cost of capital minus the growth rate. The value that you get for this restaurant is 1.45 million. You subtract out the lease debt. Don't forget the lease debt because I took the leases, made them into debt. The restaurant value would be 521,000. As a multiple of net income, you're paying like 3 times net income, right? You think that's a really low multiple. It's a really low multiple because you're undiversified, you're demanding. This is why you can't take price earnings ratios for public companies, apply them to a private business, say, isn't that what I should be getting? There should be a discount, and that discount reflects partly this non-diversification. Now, I'll wager that the French chef is going to be disappointed with this number because he was probably expecting $1 million, $1.5 million, 2 million. Let's say he comes to you and says, is there something I can do to get a higher value? One is you can try to get rid of the key person discount, but that's going to make him go from 521,000 to maybe 700 or 750,000. Not a quantum leap, but it's better than 521,000. Is there something else you can do?
Get it to a more diversified.
Find a better buyer. If you have a private business to sell, finding the right buyer is 90% of the game. What do I mean by that? If you think about doing this, and I'll show you what the value will be if the potential buyer is a diversified buyer who doesn't care about liquidity. Because not only do you get this problem with private buyers not being diversified, they're also going to be much more wary about illiquidity. Why? Because I got my entire wealth now tied up in this restaurant. I remember, how do I factor that in? That's an illiquidity discount we talked about. And the reason it's so tricky to estimate how much that discount is going to be is it's going to vary across companies. For instance, the amount of discount, the percentage discount I might attach to a company will be far smaller if it's a healthy money-making company than if it's a young, growing, money-losing company. It's going to be greater for some buyers than for others, right? A buyer who's long-term, who doesn't need the cash, is going to value liquidity less than somebody who might need the cash quickly. And it'll vary across time. You're saying, why? Imagine trying to sell your business in November of 2008, in the middle of that crisis, or March of 2020. When the market's in a crisis, everybody values liquidity more. So it's going to vary across companies, it's going to vary across buyers, and it's going to vary across time. This is really bad news. You know why? Because if you ask me, what can I use as a discount? I can't give you a number. It depends on the company, it depends on the buyer, it depends on the time you're doing it. I can give you a process for estimating it, but there's no one number. I can say, take off 20%, because that's not going to work for every company. It's not going to work for every buyer. It's not going to work across time. So here's what I'm going to do. I'm going to start with the way most appraisers deal with the liquidity now. It's horrifyingly bludgeon-like. And we'll talk about ways in which you can finesse it. The way in which appraisers deal with the liquidity is they knock off a fixed amount of every company. It's like a rule of thumb. Take off 20%. Take off 25%. You're saying, where did they come up with? There's a modicum of backing to it. They back it up with studies. There are a couple of studies they look at. To estimate how much people pay, care about liquidity, you got to find public companies. Why? Because you can observe the market price and you can see what happens when people have their liquidity cut off. I'll give you 2 cases where you might be able to observe the liquidity discount. Public companies, usually when they issue shares, raise fresh capital, have to go through an SEC registration and approval process. But sometimes public companies can jump that process, skip that process, issue shares directly, but with a caveat. These are called restricted shares, and they can be issued, but you can't trade those shares. These are public company shares, but you can't trade those shares for 1 to 2 years after you get them. So basically, you have a public company, it's trading at $10 per share. You're a potential buyer, comes say, would you take 1 million shares? And you like my company. You say, okay, I'll take 1 million shares. So by the way, you can't sell those shares for the next 2 years. First, tell me, would you pay the same $10 that everybody else is paying? Probably not. You'd probably pay a lower number. I get to observe what that illiquidity discount is. That's one place where you can observe it. The second is around IPOs. And this is tricky. Now, when you look at companies going public, there are owners in this company before it goes public. And there are sometimes transactions that occur between owners of private businesses in the weeks or months leading up to an IPO. So what studies look at is what price people paid on those transactions relative to the IPO price. So if the IPO price is 10 and you sold your shares at 650 to me 2 weeks before the IPO, your illiquidity discount was 35%. That's huge for a 2-week period, but no, who am I to fight the price? So when you look at private company appraisers, the way they back up these hefty discounts is by pointing to these two group studies. The problem with both of these groups of companies is there's a huge sampling bias. Let's talk about the sampling bias, and let me describe what these studies find, and then I'll talk about the sampling bias. So if you look at typical restricted stocks, there's the discount you would see on the restricted shares vary across companies. Some companies it's bigger, some companies it's smaller. So you can actually observe the extent of the discount. So let's talk about the sampling bias. If you're a healthy company, would you ever leave 20% of your money on the table because you need money in a hurry? Oh, let me frame it differently. What kinds of companies would issue restricted stock if the discount you're seeing is 25, 30, or 35%? These studies consistently find discounts of 30, 35%, which is then used by private company appraisers. Look, the discount can be 30%. That's what but step back. If you're a public company and you're issuing restricted shares at a 30% discount, you're probably basket case companies desperate for money. In other words, we're taking a statistic that comes not from looking at the overall market, but of a subset of companies that are desperate for cash. And what are we finding? Because they're desperate for cash, they're paying a huge amount for illiquidity. And now appraisers are taking that and applying that in every private business. They were able to get away with it for about 25 years. You know why? Because the IRS was too cheap to hire an expert witness who actually knew statistics. It was only about 20 years ago that finally the IRS ponied up the money, and all the statistics person had to do is look at the characteristics of companies that issue restricted stock and compare them with the rest of the market and say, you know what, these restricted stock companies are smaller, they tend to lose money, and they have a lot of debt. You cannot extrapolate from that. But that's basically been the basis for private. Why do private company appraisers like to have big illiquidity discounts? Remember I said most private company valuations are not for transactions. They're for tax court and divorce court. In which case, what's your objective? To make the number as small as possible. There's a history in private company appraisal of looking for discounts. And guess what? These studies fed into those discounts. But there is some information across the restricted stocks that is of value. Bill Silber used to teach the foundations class here for almost 40 years. Last because he did this paper one summer. And it was a throwaway paper. It ended up being one of his most referenced papers, where he took all of the restricted stocks. He took the discount in each one, but rather than stopping there and averaging out, which is what all the studies had done up to then, he looked to see why there were differences across the companies. He found that larger companies had smaller discounts. So the way to read this is he looked at the price at which the stock was placed. So it's like 1 minus the discount on the left-hand side. So the more revenues a company had, the smaller the discount. Bigger companies had smaller liquidity discounts, which makes sense. He put in a dummy variable for earnings, and he saw that money-losing companies had bigger discounts than money-making companies. And finally, he looked at what percentage of the share. So if you were offering 5% versus 50%, the larger the block that you were placing, the bigger the discount. So his objective was to say, look, discounts vary, but they vary for good reasons. I stole his regression and used it to kind of adapt it to my discount. So for instance, if I could tell you how much the discount changes as revenues change, maybe I can steal that. And here's how I would do it. Right now, private company appraisers use a constant. Let's say it's 25%. But let's suppose you told me your revenues were 50 million as a private company. I could then look at how much lower your discount would have to be because your revenues are 50 million and adjust your discount for how much revenue you had. So I took the silver regression and I took those coefficients and said, I can now tell you how much lower your discount is going to be if your revenues are much bigger. So if you have, for instance, $1 billion in revenues, your discount, so I'm used 25% as my starting point, my base, your discount will drop to 16%. This is for those appraisers who are so wedded to that starting point, their frame of reference around 25%. Say, okay, stay with the 25, but I'll give you a way you can adapt it so bigger companies have smaller discounts. I also looked at what the discount would be if you're a money losing versus a money making company based on the coefficient that I got from the regression. And guess what? If you're a money making company, your discount is much smaller than if you're a money losing company. So if you're really stuck on a fixed illiquidity discount, I can build on that. I can work with that and try to at least tell you how you can adjust that discount based on restricted stock. But I think you're building off a really shaky base by looking at restricted stocks. The first time I saw an IPO stock study, I don't know whether I have the graph. You know what the typical discount these studies find for pre-IPO transactions? Like 40%. I said, there's no way. I mean, put yourself in the shoes. There's going to be an IPO 4 weeks from now. Would you sell at a 40% discount? I wouldn't. Then I said, who's doing all of this? And here's what they were missing. They were looking at actual IPOs and working backwards. Let me ask you a question. Does every company that plan to go public end up going public? No, there are lots of companies that start the process and fall out. And by focusing on just the companies that went public, they create the sampling bias. Be very careful about all these academic studies that claim to find things. Take a look at the sample and say, what is that sample? Is that a sample that I can use to extrapolate to the rest of the market? Or is the sample very specific to a subgroup of companies? And a lot of the illiquidity discount studies are based on that subgroups. Yep.
Unless the bank takes all of the exposure or the syndicating bank or the medium.
Well, then you would never sell it. I mean, but that's on the offering day, right? For that to happen, there's actually got to be an IPO. Remember, there are companies where the IPO never happens because the offering price the bank gives is too low and the company decides to pull. I know at least 5 companies in the last month that have pulled their IPOs because the market has turned against them. Those won't show up in the study, right? So there were transactions in those companies. Those people might actually make more money than because the IPO never happened. They are not in the sample, so we're overstating the discount. Yep.
So do these pre-IPO shares have some kind of locking that you cannot sell for 1 year?
If you stay in the IPO, at least if you're one of the big owners, many of these IPOs come in with lock and we can't trade the shares for 6 months. So you're saying, would I accept a 40% discount for that? Maybe 6%, maybe 8%, or 40% just doesn't stand up to the scrutiny of common sense. No, but because remember, you can borrow against these shares. It's not like they're completely, you can't cash out. So I find it very difficult to believe that you get a 40 to 50% in liquidity discount. Yes.
There is another aspect. In 2018 to the beginning of 2020, there was approximately 40 IPOs of stock companies.
Yep.
The median percentage of increase in the stock between the institutional price and the ending first day trading was about 36%. And only one company out of those 40 IPOs lost money.
Well, we know, I mean, there's a much longer time series, right? You go back to 1970, we know on the offering day, on average, the IPO price is up 15%. Well, part of it is if you're the banker and you guarantee a price, do you want to guarantee a low price or a high price?
you want to get the.
You want to get the deal done.
successful.
The very nature of guaranteeing a price almost ensures that you're going to lowball the price. So it's built into the process. Later on, we're going to talk about why you can't make money on it systematically, because it seems like an easy way to make money. Just get in the offering price, sell at the end of the day, collect your 15%. It's been one of those the things that people have sought year after year, but they never seem to be able to cash in. We'll talk about why that happens. Okay, I'll see you on Wednesday.
Yeah.